Anyone in their 20s that starts a policy is doing one of the most valuable things, because number one, you are establishing a ground floor foundation. You'll have more money tomorrow than you have today. You'll have more money next week than you have today. You'll have more money next year than you have today. Uninterrupted compounding interest kicks in, and you will always have guaranteed growth. It can never go down. No ifs, no ands, no buts. How many of you want to leave a gift like that to your child? Welcome everybody to the Wealth Webinar, another week. We do this webinar each and every single week. Mr. Snaggy and myself love pouring into you. You know, it's been since 2019, Stephen. Can you believe that? We've been doing this webinar every single week since 2019, completely free. And all we're trying to do is serve all of you, make sure all of you know how to take back control of your money and you know how to be your own bank. And that's what we're going to do today. Last week, I had announced that we were going to start asking our audience what topics they want to learn more about. And on the Ask Me Anything happy hour, which we do every single Wednesday at 4:30, to join that, you just subscribe to my YouTube channel, which I was just playing, at the Chris Naugle, and there's a little bell. You hit the bell, and that will notify you when we go live for WTF, which is our morning show every Wednesday. There's a riot. And then every afternoon, 4:30 Eastern, we do Ask Me Anything happy hour, where we answer questions. And one of the questions that came up that I thought was really good and is going to be the baseline for today's training is somebody on the webinar asked, what are 5 reasons to do the infinite banking concepts in your 20s? So then what we did, and Shauna did, is we said, okay, if we're going to do what you would do in your 20s, well, why don't we do why would you use the infinite banking concepts if you're in your 60s? So those are going to be 2 top line things we're going to talk about. 5 reasons to use the infinite banking concept if you're in your 20s, 5 reasons to use the infinite banking concept if you're in your 60s. And then I got some really cool stuff to do, which is the opportunities that you can have from controlling your capital. And I've got I've got something I'm going to try to pull off, and I'm going to do it at the end. So stick around to the very end, otherwise you're going to miss it. It'll be the first time ever doing it. It's like a case study, but I can't use the client's name. And I'm going to show you how a client that started with us in 2021, who forgot and lost their way. They kind of forgot why they were doing this. And they sent a message out saying, hey, you know, I don't know why I'm doing this. This doesn't make any sense. Why am I paying interest to use my own money? Well, what I did is I take questions like that serious. So when we get a question from a client like that, to me, that's like a big warning light that goes up. And I'm like, I have to jump in and save the day. And how I save the day is mathematics. Everything you're going to learn today is all based in mathematics. I can prove how the infinite banking concepts will solve your problems and many others mathematically. And I'm going to show you the math today. I'm going to show you the real math based on a real client, based on a real problem they're having, and that is they lost their way. They forgot what it was like to be their own bank. They started thinking, oh, maybe I should go back to the traditional way of thinking and just put money in a bank account, because why would I pay interest on my own money when I can put money in a bank and just go out there and make money? But here is what you must remember. And I'm going to ask it in a question form. Would you prefer to make money twice on your dollar, or would you prefer to make money once on your dollar? Put it in the chat. You could either put once. So would you like to make 12% on your money once, or would you like to make a return on your money twice without working harder, longer, or taking any risk? Sandy said twice. Terry said twice. Christian said 3 times, which you definitely can do. But we're just going to keep it simple in 1 and 2. Got it. All right. So everybody said twice. Now, let me ask you another question. Who is here for the very first time? Put first in the chat. Who's here for the first time? I don't want to screw the name up, but how would you say that, Stephen? We got Lamia. I would almost Lamia. I'm probably butchering your name. I'm so sorry.
Lamia.
There we go. Got it. All right. Fry's here for the first time. We got Samantha. We got Shona. We got Sandy. Okay. We got that one. Adrian. They're going quick. They're coming quick. We got William. God, I'm missing some of them. Well, Susan, awesome. Well, welcome here to all of you, and also welcome here to everybody who's been here for years. We appreciate it. This is what we call our campfire, and we are going to deliver the value. So I'm just going to dive right in. The first thing I want everybody to understand is when we're talking about the infinite banking concepts, folks, we're talking about a process of you taking back your banking functions. So what does that mean? Well, today, a couple things happen. Your money goes into someone else's account. That is a bank. Okay, so your money goes into a traditional bank account. You work for that, but you deposit that money into the bank. And in return, the bank pays you a return on that. I don't know, 1 to maybe 4% today. And then from there, you pay your bills and you also save money. From the bank, your savings has to go somewhere. Now, many of you put that money in a 401k or a retirement plan. Some of you invest in real estate. Some of you are doing stocks. Some of you are crypto people. Okay, so this is how you invest. This is what you've been taught. You work for the money, you take the money, you put it into a bank, you then have that money go out. Each one of these options means your money gets to make a return once or a loss. Okay, so it doesn't matter. Because when you take the money from your bank account, which was paying you 1 to 4%, and you invest it, this stops. You cannot earn interest on your money in the bank when you take the money out to invest it. Everybody understands that. It's just logic. But what if you could? What if by changing where your savings goes first, you put it into a different account? Okay, we'll just call this your IBC account, where then you do the same thing. You take your savings out, but your money never leaves, okay? You literally take a loan from your account and you make it go to work, okay? And I also will put lending up here too, because we're really big about private lending. Okay, so when you do that, your money never left the account. So let's just say your money was making 4% here. It's still making 4% while it's making a return. So the biggest thing to understand with the infinite banking concepts is you do not need to decide, should I do this or should I do that? Okay, a lot of you have to make that decision now, which is a common thing we hear. They're like, well, should I leave the money in the bank or should I invest in stock? Should I invest in real estate? Should I invest in crypto? Should I lend the money out? It's a decision. And sometimes that decision is crippling because you just can't make up your mind. Should I leave the money in the safe old bank and make that 1 to 4%? Or should I take it and put it to risk and put it over here to make a bigger return? What if it was this and that? What if you could have the return, okay, that you're getting in the safe place, the guaranteed place, but then you can make a return a second time? That's all we're talking about. The second thing we're going to talk about is not just making money twice on the same dollar. It is solely about control, okay? That is the most important thing, control. So right now, when you put money in the bank takes your money and lends your money out at a higher interest rate than what they're paying you. So if the bank is paying you 1 to 4% interest on your money, the bank itself, okay, we'll just do it this way, the bank is lending that money out at probably 6 to 10%. And in the middle, they're making a spread, but nobody ever gets upset about this. Nobody thinks about this. It's like, oh, that's fine. The bank could not operate if you didn't make deposits there. If you did what we teach and you became your own bank and you moved your money to another place where it earned a much better return, because right now we're getting 5.5, our highest company is 6.4%. Okay, we're getting that, of which most of that money is 3% guaranteed. Okay, so all of this money, 3% of that is lock, stock, and barrel guaranteed contractually. The rest is in the form of a dividend. And when you change this, the bank no longer can use your money because you now control that money. All right, so let's dive into this. I just wanted to give a quick baseline for all the first timers here that what we're talking about is a process. Notice I didn't say a product. There's not a magic product here. There is a product involved, but it's a machine that we're going to run money through. But we're not here to talk about that. We're here to talk about the process, okay? Because that's what you're going to learn, the process of you taking back the banking functions in your life. So let me dive in. I've got these all written out. My team put this together, and I thought these were phenomenal. So what are the 5 reasons? So I'll put this up here. I like drawing things. So what are the 5 reasons you would do IBC in your 20s? That's the question. So the first thing in this first one is I'm going to talk about my daughter. It is leveraging time. Time is our single most valuable resource we have. You all know that. And the more time you have to invest money, the more time you have to save money, and the more time, I want you to pay attention to this, the more time you have for your money to compound, the better off you will be later. Just think about this, folks. All of you are varying ages. I'm 47 years old, but just imagine if you could turn the clock back to when you were a child. And imagine if somebody, your parents specifically, or grandparents for that matter, took and put a little bit of money away every single month for you in a place that was protected, guaranteed, and compounded uninterrupted. Imagine that your grandparents or your parents put money away over there for you. So let's just say they started that when you were 5. How old are you now? Are you 20, 30, 40, 50? How old are you? That's a lot of time. 10, 20, 30, 40, 50 years of compounding interest. Do you realize it wouldn't take much money to make a massive impact if you did that, or if your parents did that for you? So the question I always ask is, why are our parents not doing that? Okay? Why is it that most parents are not taking and saving money for their kids? And if they are, how come they're literally making their kids captive to their wishes, i.e. 529 plans? So when a child is a child, a lot of parents will put money into a 529 plan. A lot of parents will put money into a Roth IRA for their kids. But what you're essentially doing when you do that is you're literally saying, my kid has to go to college. Well, what if your kid doesn't want to go to college? What if your kid wants to be an entrepreneur? What if your kid goes off and becomes a professional athlete? What if your kid has a different path that does not involve college? You just saved all that money for all the most valuable years in an account that doesn't serve the high-arching goals of your child. You literally are telling your kid to live the same life you did, do the same things you did, and this is what I did for you. Why don't we make it so that our kids can be the ones that decide? And then we just give them the means, or don't give them the means for that matter. Wouldn't that make more sense? And a lot of parents put money in Roth IRAs. I'm not saying there's anything wrong with that, but what you're doing is you're essentially saying to your child, hey, I know you have goals, and I know you want to do things, but you can't use this money till 59 and a half. Is that really what we want to do for our kids? Let me tell you a story before I get into this about leveraging time. When I was a young boy, I would watch my mother. Now, I didn't come from a family with money, but I would watch my mom come home every day after we'd go to the grocery store or out to get gas or whatever it was. We'd come home. She would empty her purse, the change in her purse, and we had this glass big jug, and she would drop it in there. And in my mind, because I was a young child and I watched this happen so many times, I got so inherently used to hearing the sound of those coins dropping in. Can you all just close your eyes and just imagine the sound of change hitting the bottom of a jar? But then imagine the sound of that change going in and hitting the bottom of more coins. You know that sound, chink. That sound is money, right? And what does that trigger for you? To me, that triggers solving a problem. Because my mom was saving up one summer for a new lawnmower. You see, we had this beat up old lawnmower that we'd had forever. It barely ran, and we had almost 2 acres of land. So we had to mow that land. I can't count how many times my mom got stranded in the backyard because that mower stopped working. Then she'd have to go to the various neighbors and borrow a mower or have them come over and help, get the lawn mowed. And that was a big problem. So one summer, my mom set out to save to buy a new mower. Consciously, every time she went out, she would take her change. And what do we do with our change when we pay cash for something? Usually there's like a little, charity next to the register. We drop it in there. So you know the sound. But imagine now, I'm not saying don't give, but imagine you come home and you drop that money into a jug with a purpose. The purpose is we're going to buy a brand new 12 horsepower Sears Craftsman lawnmower. And how did I know what that was? Because my mom took me numerous times to the Sears store. You see, back then we had Sears stores. To the Sears store where I sat on that mower. I got used to the smell of that engine smell, like the Sears Craftsman store. It just had that smell. It was the same smell as the Honda dealership or the Suzuki or the Kawasaki dealership, right? You know these smells and you know these sounds because these are what we grew up with. That's what I got used to, watching mom save this money. I remember the day where me and mom, it was a weekend, sat down, we emptied that whole big glass jug on mom's floor. And we sat there and we rolled coins for hours. And at the end of rolling all those coins, guess what we had? We had just enough money to go buy that lawnmower. Now, let me just get all of you to think about this. Can you imagine how proud my mom was? Can you imagine the feeling of mom and I going to that Sears Craftsman store, not to just sit on it, not to just look at it, but to actually take it home? And can you imagine the feeling of when we got it home? Like it was almost like a battle. Who's going to mow the lawn today? I wanna. I mowed the lawn that entire summer in pure bliss. And it wasn't just because I liked mowing lawn. It was because I watched the process of the work that went into saving to have something. I feel like a lot of kids today have lost that. I feel like a lot of kids don't have that same feeling anymore because when they want something, they just swipe a credit card and boom, it's there. Or they just finance it and boom, it's there. It's different, folks. You see, that went on to me saving money. I would go around, mow lawns at grandma's. She lived in a trailer home park. I'd go around and I would clean windows for all the mobile homes. And I think I charged like $5 or $10. And then when I'd get that money, I'd give it to my mom. And she got me this little box. If you watch my TEDx talk, I actually show the slide top. It's a wooden box. And my mom would put the money in there. Now, I always let my mom be a steward of my money. And she saved up. Now, I was infatuated with a KX60 dirt bike, to the point where every day at school, I would draw pictures of this on my Trapper Keepers. I would just dream about this. It was so vivid to me about this dirt bike. I got a little bigger, okay, because it took a lot of time of mowing lawns and doing this to save up enough. But the following summer, Mom took me to the Kawasaki dealership. It was called Hebler's. The owner of the place name was Joe. Joe knew me because I was that little kid that was always in the shop looking at everything that never bought anything. I just was always there looking. I was admiring the bikes. Well, I had elevated up from a 60 to a 125, and that day was special. We had prearranged it where I was going to go there and I was going to test drive an RM125 and a KX125. And I remember on the side of the building, Joe let me ride those dirt bikes, and oh my gosh, it was the greatest day of my life. So much so that when I got done riding them, I thanked Joe and I said, I'm still saving up, but I'm going to own one of these. And I'm getting ready to leave. My mom stops me and she says, Chris, would you like to take that bike home with you? And I said, of course I would, Mom, but I got to save up enough. And then she told me, you've saved up enough money and you can take that dirt bike home. Was my experience different with that dirt bike than it would have been for a kid that just, said, Mom, I want a dirt bike for my birthday, and then all of a sudden the dirt bike's there for their birthday? I'm not saying there's anything wrong with that, but just I was taught something. I was taught how to save money, but it also took time. So let me show you something, folks, and this is going to wrap up number one, leveraging time through compounding interest. I want to show you what this looks like because all of you probably have kids. Now, if you do have kids, I want you to realize that you can save any dollar amount you want into their own banking system, and their own banking system looks a lot like this. This is my daughter's first specially designed and engineered whole life. This policy was done through a company called Mass Mutual. I decided to save on her first policy $5,000. Now, bear with me. This policy was designed differently than I would design your policies. Maybe not your kids' policies, but your policies, because I did not design this for the highest early cash value because the goal is not tomorrow or the next day. My daughter's 4.5. When I took this out, she was 6 months old. Leveraging time. So when I do this, I just want you to kind of look. I don't want you to focus on these numbers because obviously that's not good, right? You put 5,000 and you get 2,200. Chris, you always say that when you put money into these specially designed whole lives, you're going to have access to between 60 and 90%. That's not even close, right? Because I've designed it backwards for my daughter. I wanted this thing to be more efficient later versus earlier. So therefore, this policy design was designed for tomorrow. So I just want you to look at this. Now, the goal for this was various, and it can be many things. I might include a car purchase in here, but let's just go through. I put $5,000 a year away for my daughter. Not a lot of money. And for some of you, maybe it's $1,500. For some of you, maybe it's $2,000. Some of you might want to put 50 grand away for your kid. I don't care. Mine was 5 grand on this. But here's what $5,000 compounding over a period of time looks like. When my daughter gets to the point where she goes to school, I show my daughter taking $20,000 out of her bank instead of student loans to pay for college. Now, we never pay these loans back to the policy in this example, but that is not what I teach. I would always tell you to pay the loan back and be an honest banker, but this is just an example. The only thing we're doing on the loans is paying interest on the loans we take out, but we're paying that out of pocket. Okay, my daughter would pay the interest on these loans, but that's all we're paying. So we took out $80,000 of the 153 she had at that, or sorry, the 119,000 she had, leaving $99,000 in the policy that first year. So we've taken out 80 grand. Then my daughter gets married and we spend $40,000 on a wedding. So we take a $40,000 loan from the policy. So we borrowed $120,000. Then a house down payment of $60,000. Okay. So now she's got $180,000 in loans of $334,000. So she's taken $180,000 out, but she has $334,669 earning uninterrupted compounding interest. Every time she takes money out, it doesn't matter because all of her money is still earning interest and dividends. If you don't understand that, we'll come back to that. Fast forward. Then she has kids. I'll be long gone. Then she pays $30,000 each year for her kids to go to school. So she's taken $300,000 out in loans, of which she has $1,052,000 earning guaranteed interest and dividends. Then she retires and she takes $90,000 tax-free out every single year for the rest of her life. At 90 years old, she goes on and graduates and she gets to go live with dad, mom, and God. So at that point, here's the numbers. She had $5.7 million of money earning guaranteed interest and dividends, okay, of which she used $2.73 million. A death benefit upon her death was paid out to her kids or the trust, because I have already set up a living trust, a family banking trust. So this $4 million would go to the trust to fund future generations so that they can be their own banks. But here's the math. Total amount put into this policy, $398,000. $5,000 all the way up to the time she was 60 some years old, then $3,000 until she was 90. No big deal. That was it. She took loans for $2.73 million, of which she earned interest on $5.5 million because she didn't use it all. She had a net cash value upon death of $2.9 million. Her cumulative net return on her money was 738.41%. How many of you want to leave a gift like that to your child? But you see, it's interesting. I'm not just leaving that gift for my child. I'm leaving that gift for her kids and her kids' kids and her kids' kids' kids and her kids' 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 kids. In my trust, I have one wish. When I'm gone, every year, every child born into our family bloodline gets a check on their birthday from Grandpa Naugle, from Grandpa Chris Naugle, every year. Many of these grandchildren will never remember Grandpa Chris. I will have been long gone. But they will remember that they get a check every single year because of compounding interest and because leveraging time. That is the first reason. The second reason, creating a strong financial foundation. Anyone in their 20s that starts a policy is doing one of the most valuable things because number one, you are establishing a ground floor foundation. When you build a house, you build a foundation. You are literally creating what I like to call, and Shauna likes to call, a forced savings plan. If you join us for the experience out in Sundance, Utah in February, please take a second, pull Shauna aside and ask her about her first policy she started, her forced savings plan. And ask her about all the vacations she was able to use that banking system to pay for. But not only that, ask her about the surprise she got this year when she got her statement. She had tens of thousands of dollars unexpected in cash value because of compounding interest over the last, 5 years she's been doing this. You see, what we do is when we implement the infinite banking concepts, when we change where our money goes first, what we are doing is creating a forced savings plan. So the first thing is leverage time. And that was the compounding interest, right? So compounding interest. Number two in the five is create a strong guaranteed foundation. And how we do that is we create a forced savings plan. And a forced savings plan is nothing more than automating the amount you save every single month. Start small, please, folks. Please start small. I started with $240 a month. I now have like 13 of these things and put hundreds of thousands into them, but please don't start there unless you have the means and the future means to be able to continue that. A forced savings should be out of sight, out of mind. It should be money you can save today and not worry about. It should be money you can save today that you still can afford rent and mortgage and car payments and everything else. But your car payments in the future will be paid back to your banking system. Hold that. Number three, building liquidity. One of the biggest mistakes I think a lot of folks make is they invest, but they have no liquidity. They put money in 401ks, of which they can't take it out without penalties and taxes. They put money into investments that they don't have liquidity in. They put money into places that they can't use the money. So it's just locked up there. CDs, annuities, 401ks, 403bs, IRAs. Think of all the places you have put money where that money's locked up. You can't get to it. So then what happens is a big opportunity comes. The market tanks. You can buy every stock 50, 60% off. And what do you say? Damn, I wish I didn't have all my money locked up in that place. You see, when you create your own banking system, you are forcing liquidity into your savings plan because that is the way to do it. But you're also creating a self-fulfilling prophecy almost, because the liquidity is self-generating. It's self-generating because eventually you use the leverage of time to create a foundation, which is then used to buy back all the money that you're giving away. In other words, you're making car payments to someone else's bank. Eventually, you're going to make car payments to your bank. You're paying credit cards to someone else's bank. Eventually, you're going to make those credit card payments back to your bank, all because you're following these. And if you do this in your 20s, folks, it will crush it. Number 4, I know none of you like paying taxes, so why not do something? Do you want to put money in a place where every single year Uncle Sam gets to dip his dirty hands in your cookie jar? Where he takes just a little bit of money out? You made a little, you're so happy, then all of a sudden you get the 1099, and now all of a sudden that's Uncle Sam taking money. You just got yourself into a high yield savings account, but then at the end of the year, the damn bank sends you a 1099 and you got to pay interest on that little bit of interest the bank paid you over the year that you thought you were doing good on. How many of you feel good about that? Well, stop it. Put your money in a tax-advantaged account. Put your money in an account that you don't have to pay tax on the internal buildup of that account. That isn't CDs. That isn't savings accounts. That isn't high-yield savings accounts. That is specially designed and engineered life insurance policies, whole life insurance policies that you can benefit from the tax advantages, because inside your policy, if designed properly, and that is the only thing we do is design these properly. Folks, we're going to put a link up. If any of you want to talk to one of our mentors about how to set this up for yourself and how to get your policy designed the right way for maximum liquidity, high early cash value, and to maintain the ability to have that money grow tax-free, the internal cash value buildup is tax-free for the rest of your life or for the rest of your child's life, okay, in talking about this for 20. And the very last one that I want to call out is avoid challenges. So when you're in your 20s, we want to try to take advice from people that have done things that allow us to get there faster than they were able to. And all the thing we want to do is we want to make sure that we set something up, the foundation we set up, that nobody can take it away from us. You see, here's one thing that happens a lot. A lot of people want to set up policies. Just had this happen the other day, and I was heartbroken by it because I didn't think this was going to happen. And I'll tell you the story. So I got an email about a client we were working with. And this was a big client. Like, they were putting a ton of money away. So obviously that was a big hit for us because we were excited about this, but it was a huge hit for the client because they had tons of plans of how to use their own banking system. They knew everything they were going to do. We mapped it all out. We created all the systems and tools for them to use their own banking system. We knew exactly what was going to happen. But unfortunately, we got news that the insurance company denied their policy because of medical reasons. You see, they were no longer insurable. Now, none of us ever know when that day is going to happen. You never know if that's going to happen on your drive home. You never know if at night you're going to wake up and you're going to be like, oh my God, I don't feel right. You go to the hospital and all of a sudden you have an illness or something wrong with you that will prevent you for the rest of your life forever being able to do what I'm teaching you. But you see, if you're in your 20s, you're in your peak health. This is the time where you'd want to lock in that insurability, where you'd want to avoid the challenges and make sure that there are no worries about pre-existing conditions, so you lock it in. So these are some of the reasons to do this in your 20s, and there are lots more, but I just want to hit the basics. So what I'm going to do is right here, I'm going to move on, and I'm going to move to the next category, which is 5 reasons in your 60s, but I want to pause. And I wanted to see, Stephen, do we have any questions or any thoughts anyone said?
Nothing really specific, just some good chats going, but you keep rolling.
Okay. Cool. All right, I'm going to bring this to some stuff, and we're going to look at some real numbers. So right here, life-changing. One regret, I didn't know about this sooner. How often we hear that. So now in your 60s, so we're going from my daughter's policy. My daughter was 6 months old. We were talking about 20-year-olds. And now we're going to go and we're going to forward pace to folks in their 60s, which may be some of you watching this webinar right here and right now. So there's a lot of differences from when you were 60 to from when you were 20s to when you're 60s. Your priorities have changed. Hugs matter a lot more when you're in your 60s than they did in your 20s. The fancy things in life aren't as important when you're in your 60s. You see, time is more important. So buying back our time is one of the most important things as we get older, because we become wise and we realize that the thing that we always wanted was more time to spend with family and loved ones and friends, more time to do the things we want to do. That is what becomes important as we hit our 60s. And listen, I'm only in my late 40s, but I've worked and dealt with so many people in their 60s. And I can tell you, there's not one person that doesn't value time more in their 60s than they did in their 20s. So the number one thing that a lot of people in their 60s doesn't want to do is they don't want to restart. They don't want to have to redo all this. They've worked their entire lives. They've saved their entire lives. They don't want to redo. They don't want to go back. They don't want to worry about a market crash that took all their wealth away. They want stability. So the first reason is number one, stability. Anyway, forget about the spelling, folks. I'm trying to teach. And they want low-risk assets. How many of you are in your 60s? Put I in the chat. And I'm going to get to 80s, Charles. I'll hit that. 60s, 80s, not much different. But I bet you any money, Charles, let's just do this with you. See your question. So Charles was saying, what do you recommend when you're 80s? Well, let me ask you, Charles, or anybody from 60 to 80 years old, do you want to take on a lot of risk with your money? No, because you don't have time to recover. When you're in your 20s, you could ride the time, you could ride the market up. But when you're in your 60s and 80s, even if you think you have time or do have time, do you really want to have to redo it all? So one of the things I find a lot, working with lots of people in their 60s and even 80s, Charles, is they want stability. They want to wake up every morning knowing their money's there, and they want their money growing, but they're not as concerned about taking the big risks to double their money. They just want to know tomorrow there's more money than there was the day before. Next year, there's more money than there was the year before that. And in 5 years, there's going to be a lot more money than there was today without any risk and without having to work any longer or harder. So number one, what the infinite banking concept does, what these specially designed policies does is just that. Guaranteed you will have more money every day, or you'll have more money tomorrow than you have today. You'll have more money next week than you have today. You'll have more money next year than you have today. If you do this plan, the thing called mathematics kicks in and uninterrupted compounding interest kicks in, and you will always have guaranteed growth. It can never go down. No ifs, no ands, no buts. So stability is really important. Stephen, did anyone say anything different? That is awesome. David said his dad is 99. Let's just take a second and put our hands together for David's dad, 99 years old. Man, that is an awesome life, and what an accomplishment. I just got some bad news this morning. Our old property manager, or not property manager, basically he was like our general contractor, our project manager, became a dear friend. I knew his parents well. He lost his mom this morning. She was in her 90s, but you know, still, what a life, right? So the other thing too that's really important that I want to bring up, and this might be, you know, something that I would put in there, but you know, making sure that you are providing a legacy. So I'm going to skip ahead just while I'm on this, but providing a legacy. When you're in your 60s and 80s, hell, I'm 47, and this is my single most important thing. I want to leave a legacy. I want to make sure that when I'm gone, there's more left for future generations. I'm not just saying more left just for my wife and my daughter, although that is a big priority, but more left for future generations. I want to create a legacy, that check that goes to every grandchild every year with Grandpa Chris Naugle's name on it so that they remember me. So I want to create a legacy, but also one most important thing for me is I don't want Uncle Sam to get their hands in the cookie jar. Not just growing. I don't want to pay, you know, more taxes on growth inside my policies, but I also don't want to pay estate taxes. Now, right now, the estate tax limits for a family, like a family of two, is about 26 mil, give or take about 13 mil each. Okay. It's a big number, but it doesn't take much as you get rolling. When you hit your 60s to 80s, like you start accumulating lots of assets. And just if you don't do the proper planning, when you hit that time when it could be, you know, your last days, do you really want to sit there and think you're taking your last breaths, and in your mind you should be thinking about what a great life, and all of a sudden this eerie feeling comes over you and you start thinking about, oh my God, when I die, the government is going to take 40% of my estate because I failed to plan. So I just gave the government 40% of everything I've worked for my entire life. Okay, so let's just not do that. Heck, you should start planning this for your 20s, but you're not thinking that way in your 20s, but in your 60s, you certainly are. So providing a legacy, but also estate planning to make sure that the government, the IRS, is not getting 40% of our estate. The government is getting a check from an insurance company that pays the taxes so that our family doesn't have to give up any of our estate. Isn't that a better way? Who do you want paying the government? Do you want to pay the government out of your assets? Or do you want the insurance company to write the check to the government? Somebody's got to pay the piper. We all have a silent partner in our lives, and that is Uncle Sam, the IRS. So do you want to pay them, or do you want the insurance company to pay them? For me, I will give the insurance company a little bit of money each month, each year, so that they pay the Uncle Sam, and my estate is intact. My family gets to have all the things that I worked my entire life for, and nobody can tell them who takes ownership of them. So that is another thing. But number two, I think is just as important for anybody in their 60s. I already went over this, but how about tax-free retirement? So since we're on that tax thing, we don't want to give the government 40% of our estate because we went over the estate tax exclusion limits. But also, while we're taking an income in retirement, do we want to keep paying the government taxes? In other words, we get $100,000 from our retirement account. Remember, Vivi's was 90. Let's just go to 100. It's easier math. But we don't really get 100 because we put all of our money in a 401k. So actually, we get 100 minus 30% in taxes. So you take home about 70,000 of the 100. And then you struggle to even live because 70,000 is really tough for someone, a single breadwinner to afford, to be able to live on 70 grand, especially in California or Arizona or expensive places. You just can't do it. So wouldn't it be better to take 100 and not pay tax on that? Well, like I showed you with Vivi's, tax-free income is very important to folks in their 60s. And I'm going to stop and answer questions in a second, but let me just get through these other ones. Number 4, how many of you know what probate is? Does anyone know what probate is? It's kind of like that estate tax thing, but it's a little different. So probate, let me just do it in New York. In New York, any asset over 50 grand. So I'm looking at this car right here. This car is worth about $140,000. If I died tomorrow, this car doesn't just go to Vivi or Larissa. This car goes through probate, where the courts get involved and attorneys get involved to decide who gets this car if I don't do proper planning. But do I want my life insurance policy to go through probate? No. Do I want the death benefit of my life insurance to go through probate? No. Well, here's good news. Any money inside of your specially designed and engineered whole life avoids probate. So when you're putting money in a bank account, guess what? It does not avoid probate. If you got millions of dollars sitting in a bank account, tens of thousands in a bank account, 100,000 in a bank account, when you die, that is a probatable asset. Look it up. Google your state and ask what your probate limits are. New York, $50,000. Anything I own, any account I have over 50 grand, if it is not in a living trust, is probatable. I don't want to deal with that. So what I chose to do is change where my savings went first, put them into an asset that is probate. It bypasses probate, so it avoids probate, and that happens to be life insurance, specifically specially designed and engineered whole life, which is what we use to create banking systems. Number 5, health. This has been a big thing with that United Healthcare CEO that was gunned down in Manhattan, right? Healthcare, there's a big problem in healthcare, but there's also a massive problem with long-term care. So why do I even mix these two? Well, your policy and your banking system can't really fix your healthcare problem, or can it? Remember, we went over all those other things from the beginning: liquidity, guarantees, guaranteed interest, tax advantage, all the different things I mentioned, stability, tax-free. Let's say you got yourself a shitty health insurance policy and you have a procedure and you're denied for it. That could be really bad, as what we're hearing in that story. There's a major problem in our healthcare, not a problem that should ever result in somebody gunning someone down, but that's a whole nother topic for WTF this morning. But it's still a problem. But when you control your money, when your money is in a liquid place and you need a procedure done, if health insurance denies you, you just self-pay because you took the steps and you planned to have the money to self-pay. But now let me go one step further on something you don't want to self-pay. That is your long-term care. See, there's a really strong probability that all of us are going to live longer than we want to, or longer than we thought we were. And when we live so long, some things break down. We can't do the normal things, the activities of daily living. Like we can't bathe ourselves sometimes. Maybe we can't feed ourselves. Maybe we just can't go to the bathroom by ourselves. We need someone to wipe us like when we were children. Like all these things are the 5 activities of daily living. If you can't do 2 of those 5, you qualify for long-term care. And if you're in your 60s, one of the things you may want to consider looking at is asset care, or building a specially designed whole life with a long-term care rider so that that death benefit on the policy can not just be paid when you die, but can also be used to pay for some of your long-term care. In other words, when someone has to wipe your ass, excuse my language, but hey, these are real things that have to happen sometimes. Who do you want that to be? How about a professional ass wiper would be good? Sorry, I'm joking, but like, how about somebody that's what they're paid to do? But how about you don't have to pay them because you set the proper things up so that you could use part of the death benefit while you're living to make sure that somebody can take care of you, make sure that somebody's there to make sure that you can do those activities of daily living, dressing and eating and going to the bathroom and all those different things and getting around. You see, this is a major thing that there's not enough attention on long-term care, but we always go and try to get long-term care taken care of when it's too late, when we no longer qualify. So these are the things that were written down as reasons to do the infinite banking concept or set the policy up properly so that all these things can be taken care of. I think the ones that really ring out are the tax-free retirement, the stability and the no risk, the estate planning and legacy planning for our children and our families. No one wants to pay probate, and long-term care and self-paying for healthcare that you need or procedures that you want. There are so many procedures out there. Like, listen, the one thing I've found is as I've climbed up and I've gotten in higher and higher net worth clients and higher net worth rooms. I was just at Ed Milet's house Monday. Today's Wednesday. I was just there Monday. And Ed's got a problem with his back that he couldn't get any solutions at his regular physicians. Nobody could figure out how to fix it. They basically said, Ed, you're going to have to live with this pain. His like lower back, two of his vertebrae are bone to bone. But because he has money, because he rolls in a circle where he actually has access to people, he did find a procedure. It is not covered by insurance, not even close. It is not approved by whatever, the FDA or whatever they call that. I might screw the three-letter word up, but he found a person that could fix his back. But the only reason he can do that is because he saved money so that health is not a concern. He can self-pay. We all want to be in that situation. We really do. But it takes getting ahead of this early. So folks, those are the 5 when you're 20 and the 5 when you're in your 60s. I missed a lot, but I just hit high level stuff because I want to keep this sucker rolling. Now with that, I want to just take a pause and I want to just tell all of you about something really fun, and I wanted to give it to you for 30 days. So what I did is back in 2000, I don't even know, probably 19, right around the same time, I created this thing and it was called MSTV. I'm going to share this real quick in a second. I just want you to see this, called MSTV, Money School TV. And we did this right before the pandemic, and we went hard with this into the pandemic because in the pandemic, people needed information. They needed to know how to make money. They needed help with money. They needed all sorts of advice for all sorts of different topics, and they needed it at an affordable price. And I remember my wife was the reason for this because she said, nobody has any money, but everybody needs this knowledge. So you can't charge a lot. Because I wanted to charge a coaching fee. I wanted to do this big elaborate program, but she said, no. My wife said to me something, and I actually laughed at her. She said, the price is $19 a month, under $200 a year. And she said, because that is a price that everybody can afford, because that's just like having Netflix. And most people have Netflix. They might not even use it, but they don't care because it's so inexpensive. And I said to her, I said, Larissa, I can't offer this at $19 a month. We will go broke. And back then, things were very different than they are today. And she said, you can't do this for any more than $19 because you won't be able to solve the people's problems that you need to solve if you charge more. So therefore, MSTV was created. Now, so what is MSTV? It is one place where we put a lot of interesting information, and we do it in bite-sized pieces, but we are now doubling down. So what we started in 2019, what we continued through the pandemic, we are relaunching and making it world-class. And we are not changing the price. But what I wanted to do today is offer this to all of you for 30 days for free, totally free for 30 days. Test it out, dip your toe in the water, check it out. Okay, and we'll put the link in the chat in just a second. But all you need to do is just go on and click this link right here, join MSTV. What you're going to do is you're going to put your information in down here. See, it's 19, or I was actually wrong. It's 190 a year, but you're not going to have to pay that. It's going to be free for 30 days. If you don't want it, don't like it, don't use it, just don't continue it. But if you do, you can either do 19 a month or get the discounted 190 per year, and you will be in. So why would you want to do this right now? Well, if you knew that in 2025, I'm going to double down and put a ton more of my effort into MSTV versus going out and speaking. I'm going to speak at very few events next year. I'll speak at our experience, which we're going to mention in a second. I'll speak at our money tank events, the private money club money tank events, but I will probably not be on the road speaking at events like you've gotten used to, because I'm going to be doing a much better job of serving my community, which is MSTV. And I want all of you to know that this is where the effort's going to be put, right here. It is robust. It doesn't just cover IBC, although we got a lot of stuff with MSTV. It covers a lot of things. Always staying true to taking back control of your money by teaching you how to be the bank, but not just teaching you how to be the bank with things like what we normally teach. I just want to give you a quick summary of what it looks like today, and it's about to go through a major overhaul and look like a lot, but MSTV covers tons of topics like right here, all sorts of just basic how-to stuff. Down here, mindset. A lot of people struggle with lots of just basic mindset. Right here, how much money should you leave in your bank account? How should you create your story and experience and raise money? How could you, small business and taxes? And we're going to elaborate on a lot more of these. Stock market, trading, what to do with your 401k, real estate, lots of stuff on real estate, alternative solutions on different things you can do. Okay, there's all sorts of stuff, including whole life, self-directed IRAs, asset protection, but this is just one piece. Then there's performance real estate coaching sessions. There's real estate 101. And this is what I'm most proud about. This is the single biggest thing we did in 2024 that we haven't told anybody about, but this is single-handedly the most extensive IBC training ever created, and it will never be topped for the next, because we have literally 23 hours worth of content here, taking you from start A or point A all the way to Z when it comes to infinite banking. The most advanced trainings to the simplest trainings, it's all here in a super fun and easy to watch training. This is what you get. We'll put the link up. There it is. Get in there. Check it out, because it's about to get really good. And there's also going to be a whole bunch of webinars we're going to start putting on, which are only going to be put on inside of MSTV. So when we talk about proximity, when we talk about access to somebody, this will be how you get access to me. I will not be as available on all the other places, but I will be available to those that are in MSTV. That's going to literally be our inner circle, if you will. So check out MSTV. And the last thing I want to mention right here is something fun. So we're always creating new stuff. I believe in creation, and we created these hats. So these are brand new, just literally, they just arrived today. It took us a while, like well over a month to get these hats. They say, be your own bank, BYOB. It's kind of a circle logo. You either love it or hate it. My wife hates the logo. I think it looks great. These are super high quality. Anyone ever see the Merlin hats? It's the same fabric. Okay, that waterproof fabric, they fit like a freaking glove. Look at the fit on that bad boy. These things are just amazing hats. So if anyone wants these hats, what you would do, we're going to be selling them for $25. Okay, we have 2 logos in 2 colors. So you can get this one with either logo, okay, in white, or you can get the black one, either logo with like the little ribbon here. So if you're interested in these, email Shauna@chrisnaugle.com and you can grab a hat. And we're going to be doing a bunch more stuff with the hats down the line. So with that being said, let me just pause. Those are the 2 asks from me. MSTV, get in the community, check it out. 30-day free trial today, or the new hats. I just wanted to test the waters on those.
It's just someone's just saying, kind of, how will this be different from the YouTube videos?
So it'll be trainings instead of YouTube videos are always going to be the catalyst. So listen, a lot of you can get the YouTube videos totally free. I'm going to keep doubling down. I'm not going to slow my YouTube down. There will still be a video a day. But the thing that we're going to do different in MSTV is the topics are going to be completely different than topics I do on YouTube. They're going to be more involved. They're going to be more directed. We're going to do more one-on-one or group style stuff, more trainings where it's group trainings, okay, where we literally kind of like our paid coaching that we do every single month. We do a 2-hour paid coaching session. It's a group session where we talk with people. We bring people on. They voice their questions and things. And you can do that here by putting a thing in the chat or the Q&A. So you get a lot of the same stuff, but it's just going to be a different experience. And we're going to be adding a whole bunch of different webinars, which will not be available to the public, which will not be on YouTube. They will only be part of MSTV. So those are the differences that you're going to get in MSTV. Yes, we're still going to be doing the 6 webinars we do every week. As of right now, will continue exactly the same. So again, a lot of you are like, well, that's a lot of stuff. But when you get into MSTV, what we're going to be giving you is a lot more info condensed into shorter videos that are very specific in terms of topics. And then also giving you that group session. Any other questions?
Right, man. Good stuff. Good stuff.
Frank asked what website to buy the stuff. It's chrisnaugle.com. And you just go to shop. I think it's the shop section in chrisnaugle.com. How does this help Canadians? Well, everything that we're doing helps Canadians. Now, in Canada, you might not call them 401ks. They're going to be FSAs and oh God, I used to teach in Canada, so I remember the name, but your retirement accounts are called something different. Your policies, your IBC policies will work identical to how they work here, except for your tax advantages aren't quite as good as they are in the States. But everything we teach is for North America, not just the United States of America. The terminology is just a bit different. So maybe I'll do something in there and I'll actually double down on learning the Canadian terminology again so that I actually speak like I actually know. RRSPs, thank you so much. FSAs and RRSPs. All right, so I'll get those TFSAs. I thought they were TF. Yeah. Anyway, we are down to help Canadians because your stuff's not very different. You just call it some wacky terminologies. TFSAs, right? That's what it was. Awesome. Tax-free savings accounts, kind of like our Roth IRAs. Perfect. All right. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. So let me continue on. I've got this other topic here, which I think is super fun. A lot of people tell us that, hey, what do I do if I don't have debt? Because a lot of times we teach this and we teach it if somebody has debt. Now, let me just draw something here. And I'm just going to draw it instead of doing this. Remember, to do what we teach, all you need to do is your savings, not all of the money that you put into your checking account, just the savings. We change where it goes. We put it into a specially designed and engineered whole life, which I'll show you what that looks like. Then, and I'll just kind of put what we normally do. The first place we always start is we build wealth through your own debts and expenses. And that could be credit cards, that could be car loans, that could be lines of credit, anything. And we take money from our banking system and we take it in the form of a loan from the insurance company. The insurance company loans us that money right now around 5.2%. It varies by the company, but we're making a minimum of 5.75 and our highest company's 6.4. So we loan at a higher rate, a lower rate than what we're earning on the money. And I'll show you the math in just a moment, but that's how we do it. And we pay off debts. And when we pay the debts off, we take the monthly payments we were making to the debts, and we then recycle and recapture that money back into our policy. In doing so, we are making a risk-free return, because if your car loan was 7%, your credit cards were 20%, when you repay the payments back to your bank, number one, you're making 20% or 7%, whatever your loan was charging you, but you're keeping full control of your money because the payments you were giving away are now being paid back to your policy where you get to use the money. Every payment is available to you the day the check clears and you make a spread. You're making the spread instead of the bank making the spread. So that's the whole idea. But a lot of people come to us, and Shauna hears this all the time, and people say, well, hey, what do I do? Because they watch my 90-minute video, which teaches you how to get all the money back for every single car you're going to buy, drive, and own, but also shows you how to pay off debt. And people are like, yeah, but I don't have any debt, and I already paid my cars off. Now what? Well, that's where we have to go into the creativity part, and we need to think about, okay, what else could we make money in? Now, a lot of the folks we work with are in real estate. Real estate is a great asset. A lot of people love it. Either they own it or they lend on it. Okay, so we created PMC, Private Money Club, to facilitate that and to give people the opportunity of lots of deals that they can lend on. If you've never seen PMC, I'll just kind of show it to you real quick. So this is Private Money Club. All of you can join it totally free. I mean, there are paid options, to be a premier member, but when you come in, there's a community section where you can post just about anything you want. Here's just different people posting different deals, showing photos of an event that they went to. And then there's the deals section. There's a blog. There's a learning section. All the events that we do are all on here. But anyway, they come in here and here's all the deals you could lend on. You can just keep scrolling through. You can go in and say, hey, I don't want to look through them all. I only want deals that are under $50,000 with an interest rate of over 10%. So you could go in there and you could just apply your filters and boom. there's the opportunity. So this one just got funded. No surprise, no surprise. I'm surprised this one's not funded, but there's your two deals you'd have opportunities of. That's not bad. 35 grand, 15% interest for 12 months. Okay, so this is Private Money Club, and then you can get more details on the deals by clicking into it. So that's an option, okay? Now let's just assume that you were gonna do a PMC deal at 15%. Let's just go through how that would work. And now what I wanna do is I wanna pull in some numbers. So I'm gonna pull in, let's see, let's use this one, and then we're gonna jump around here. So now let's just say we got some money. Let's use 100 grand, because that's simple math. We've saved $100,000 in our specially designed whole, our private banking system. And we know that the number one goal we wanna do is get that money moving. Let's do, because I got to match this illustration. Let's do 111, because I'm going to show you the numbers. So now what we do is we take a loan. So let me just share my screen. This is going to make it easy. And we come here. So we got 111,000 we put in, and each year we're going to save $11,000. So this is a design that we did for a client. We just kind of joke around, and we made his name Speedy Gonzalez. So we had $100,000 sitting around in a bank account. He heard one of these presentations. He said, hey, I want to do that thing. Great. And he said, all right, I want to do 100. And what's the minimum I can put in after I dump in 100? 11,000 was the minimum in order for the IRS to still consider this life insurance, which maintains that tax-free growth. So now he puts 111 in, and he's got 101,000 to use, 91%. He takes 100 out, and he lends it out on Private Money Club. So he takes 100,000 out. So if he had 101, and he took 100,000 out, can anyone tell me how much money is still left in his account? I do this all the time, but some of the new folks may not know the answer. See if anybody's going to put it in the chat. So if I had 101 and I took 100 out to lend out on a deal on Private Money Club at 15% first lien position, how much money's still in my account? That's right. Steve said 101. But now I'm making 15% or $15,000. Okay, so my 100,000 is making $15,000 a year. Okay, that's 15% of 100. You could do that from your bank, but I still have 101,000 in the account growing and earning interest. So the next year comes by, this money's out there. I'm taking 15,000 a year. I'm rolling it back into the policy, of which I'm not showing you. So let's just pretend this 15K is just going into a bank account. You're just putting it into a bank account each year. Okay, so now we go to the second year. We put $11,000 in. And in that year, we can take 11,729 out, which means we made 6.63% on our 11,000. And then the next year we do 11 and we can take 12,000 out. Next year we do 11 and we can take 13 out. Do you see what's happening here? We went from making 6% that year to making 12% cash on cash to making 18%. In order to take this 100 out to make the 15%, let's just say this insurance company charged us 5%. They charged us 5% on that. What's that? 5 grand, right? So they're charging us $5,000 in interest on that 100,000. But over here, how much did we make? First year, we only made first year we lost because we've got a death benefit of 1.3, which has a cost. The next year we make 1,170, or sorry, we make 729. Then we make 1,134 from doing the math right. Then here we make 2,000. Then we make 2,770. But you see how we just keep making more and more. Now it takes time. So we have to build this thing up, but eventually we're just printing cash. But it does take time. In the first couple of years, you are not in a positive cash. But if you did it year by year, you are. 6.3 minus 5% to borrow money, 12% minus 5, 18 minus 5, 25 minus 5. You see very quickly how the math starts to really add up and work to your advantage. So I just wanted to show this to show you what the numbers look like, and also to show you that you don't have access to 100% of your money in the first year. You're at a loss in the first year, right here. You lost 9,000. Second year, now we're just not assuming that 15% interest you're earning, but you lost 8,000, you lost 7. So it took you right here 6 years to turn a positive cash return. Now, a lot of people, that's like a no-go for them. They don't want to do this because they don't want to wait 6 years to get a cumulative return. But you see, if that's how you were doing the math, and I'm trying to trick all of you, if that's how you're doing the math, you're doing it all wrong. You're sitting there and you're assuming you're going to park the money in this account. You're going to leave it sit there, okay, until it breaks even. That isn't how it's going to work. See, every single year you put money into this account, you're going to take that money out. You're going to take as much of that 100 out. This 11 you put in the next year, you're going to take that out. The 12 you put in, you're going to take that money out. The 13, you're going to take that out. What are you going to use this for? I don't know, whatever you want to invest in. And then you're going to take whatever the return is that that money makes. Okay, this is your return on the loans that you've taken out. And we're going to put that money back into the policy as a loan repayment, which now is reducing the loan and increasing your spread and your return. You cannot do this with a bank account. So if this is what you're looking at is how long does it take to cumulatively break even, you're already doing this all wrong. You are looking at this completely from the wrong lens. You are looking at this just like your bank account, like your 401k, where you put money and you leave it sit, and then you just start counting the money after it makes money. This is where you have to put the money in and get it out there working. Put it in, get it out there working. But if you don't have debt, you can lend it. You can buy stocks, you can buy crypto, you can buy real estate, you can do anything, because in the long run, the mathematics are going to work out. And that's what I want to move to next, okay? Controlling your capital. It is single-handedly one of the most important things. This model right here involves full control of your money, because your money starts here, goes out here to work, but you lost no control of it because you're still making interest and dividends on all of it. Then you take the return over here and you roll it back into your account so that you still have control. But every time you're putting money back in, you are reducing the loan, reducing the interest you're paying to the insurance company, because as that goes down, your APR, whoops, not ARP, APR goes down as well. All the while, your money keeps going round and round, fully in your control, fully building your banking system, not theirs. And over time, all of this is why we do the infinite banking concept. So that's controlling your whole cash, and it is single-handedly one of the most important things I think we do is that control. But now I got to find this. I want to show you something that's pretty interesting. Okay, this is a real client, and they started this policy. I'm going to draw this on the board in a second, but you can see this client's 3 years in. This client lost their way. They started with us. We built an amazing policy. We built a policy back in a time when the guaranteed interest on these policies was actually far more than the guaranteed interest is now. We were getting 4% guaranteed on these things back then. So he's got one heck of a machine here. And he's 3 years in. And if any of you know anything about this, and even if you're here for the first time, the one thing you must know is when you get to be 3 years into a policy, you hit what's called an efficiency point. And I want to demonstrate the efficiency point right here. And how I'm going to do that is right here, you got 81,963. Okay, 81,963. That's how much money we had in the fourth year, which is the year we're talking about. But the year before, he had 39,000. Okay, so we're going to take 39,916. Everybody sees where I got those numbers. This is the cash value. This is where he's going to be next year. This is where he's at this year. His premium deposit is 37,970. Okay, so let's just do some math. Here's how we'd figure out some things. We would take 81,963, and we would subtract the prior year, which is 39,916. That means, so if we did that, 42,047. But then that's his gross gain. That's how much his plan grew, okay, this year to this year. But then what we're going to do is we're going to subtract the premium deposit, because that's new money going in. So we're going to subtract that out. And what are we going to get? So we take that minus 37,970, $4,077. That's his net gain that year. I just did the math for you. This is from year 3 to 4. So you can see he made $42,000 for putting $37,000 in. That's a $4,077 return or total gain. But then to figure out the return, all we do is we take this 4,000 and we divide it into the 37,970. So if we do that, divided by 37,970, and that gives us 10.7%. This year, this client made 10.7% on his money. Let's just pause. I don't even care if you are smart with math, bad with math. How many of you would love to put 37,000 in a bank account and at the end of the year be able to take 42,000 out? And if you did that, you did the math and you realized I made 10.7%. How many of you would be happy with that? Put I in the chat. Would anyone be happy to make $3,000 or $4,077? Okay, now hold on. Let me ask all of you a question, and then I'm going to come back to the problem that we have with this particular situation. If you all had a bank account where you could put your money and you could make 10.7% like this, okay? You were making 10.7%, but that same bank would give you a loan for 6%, 0.06. Okay, that same bank would give you a loan for 6. So now all of a sudden you've got that money sitting in a bank, 37,000, but actually now it's 42 because you made interest on it. And that bank comes to you and offers you a loan at 6%, and you know you made 10. I just give you the math. You made 10 on that 37,000, but you could take a loan of 6 at 6%. How many of you would take a loan for 42,000 and leave your money in the bank account to make 10? Put loan or put you would take your money out. You would take the loan, every one of you. I mean, if you heard what I said, there would be not one person out of the 107 that are on here that would not take a loan at 6 when you made 10, because you'd make a spread. You would make a spread. You'd come out ahead making 4.7%, but yet you got full access of your money. So you got a loan for 42,000. How much money could you make on 42? Well, I can tell you right now, go to Private Money Club. Look at that one deal. You right now could make 15% on $42,000 that you just borrowed at 6, but you were making 10. So you made a spread of 4.7 plus, now you're making 15. How much money are you making in your money? Well, it's 15 plus the spread. How many of you would not do that? All of you would do that. There's not a single one of you that would not do that deal. So now let me come back and say one thing. What I just showed you is exactly what we do day in and day out. This is how people move money. This is what people do when they pay off their debt or to pay off debt or to buy cars. They use the policies. This policy just in that period. Now, let's do one more, and then I want to move off of this. Let's just do one more because I want you to all see the benefit of 1 year. Remember, that was 10.7. So let's write that down. 10.7 was our cash on cash return that year. Let's go 1 year later. 81 minus 125. Watch this. I'm not going to put it all on the board, but 125, 393 minus 81. So we do 125 minus 81, which is the year before. So 81, 963. That's 43,430. Okay. Subtract the premium we put in, minus the premium, which is 37. So minus 37,970. That means that year now we made 5,460. Divide that into the premium of 37. So divide it into 37,970, and we get 14%, 14.3%. Rinse and repeat. 14.3 minus 6% from the insurance company. What's our spread? Minus 0.06, 8.3%. Folks, I doubt any of you on here are making 8.3% on your S&P 500 investments or your 401k over a 10-year period. You just saw how right here in year 5 to 6, that's what you're making. What do you think it's going to be year 6 to 7, 7 to 8, 8 to 9? More, more, and more. I'm just showing you the real math. And the reason I'm showing you this is this client has lost his way. This client is so hung up on the fact that when he borrows money, he has to pay interest. And his loan interest rate right now is 5.4%. That's what he can borrow money for, 5.4. So I took it upon myself to go out there, and Craig is helping me. We're designing the whole mathematics behind this to show him, why would you care about 5.4 when you're making 10? Why would you care about 5.4 when you're making 14 or 16 or 18? It's just mathematics. You see, sometimes we prioritize the wrong things. And this particular person, great guy, has just lost his way, and he's so focused on the pennies that he's stepping over nickels to pick up pennies. His thing to me was, if I, get me the numbers, but I think I'm going to just cancel the policy. Let me ask all of you a question. How many of you on here right now would buy this policy from this client for his cash value? Or maybe even give him 10% more, $39,000. How many of you would give this client $39,916 for this policy, and all you got to do is continue funding it at 37? Christian said, look at this. Because you all understand what I just showed you. This is what this client needs to see. Now, if this client decides he doesn't want to keep this, I told him, I said, you'd be a fool to let the insurance company take this back and surrender it. Please let somebody buy this for you, because I bet you somebody will pay you 10% more than what you're going to get from the insurance company, which is this. And all of you said all day long. Frank was like, yeah, sign me up. I'll buy that thing. Can I call him? Give me it right now? Hopefully this client realizes why he did this, sees the mathematics we're going to show, and realizes that would be the dumbest thing ever for me to cancel that policy, which I just showed you the math. Would that not be stupid to cancel that thing? Absolutely. All right, I got one more section, but I do want to hit some questions. Welcome back, Stephen. How are you doing? All right, so let's see. Website to buy stuff we already hit. That's chrisnaugle.com. Is MSTV going to be an app? Yes, but see, folks, we're kind of moving away from apps. You'll notice that with Private Money Club, because I think in the future, apps aren't really going to be as important of a thing as mobile-friendly sites are. Nobody wants a new app with new passwords. Everybody wants websites that work on their phones the same way they work on their computers. That's what people want. One password, don't have to download something, don't have to go through all that nonsense. Apps are great, but mobile-friendly sites are the way of the future. So, Aaron, I will tell you that there probably will not be an app for MSTV, but there absolutely will be a mobile-friendly site, which we already have. We already have all of that in the works. And in early 2025, all that is going to launch. And we will launch the new variation of MSTV. What I'm doing now is just trying to seed it, get you guys in there, get you using it before everybody else piles in, because you'll be the early adopters and you'll probably benefit. Aaron, you know this better than anybody. When you get in early, you stand to benefit long-term, because we like our founding members. So MSTV is going to be no different than any of our PMC founding members. Fear is a dangerous friend. Yes, it is. Yes, it is. All right, so let's see. MSTV international meaning strategies are more than just USA. That is correct. That's why if you ever hear us talk about MSTV, we say MSTV worldwide. It's really not worldwide, but it's MSTV, I should say MSTV North America, but it's way more fun to say MSTV worldwide. And that's what we're going to do. So yes, it is great for Canada, actually great for a lot of different places, but it works best in North America. How do you get MSTV? We'll put that link here. I'll give you that link right now. This is the link. You just go in, you just register, free for 30 days, cancel it if you don't want to continue. If you want to continue, 19 a month or 190 a year. There's no promo code. That's the offer. That's just what it's going to be. We're not discounting it. We're not giving special offers. We're not giving you free stuff. It's 19 a month, 190 a year, and 30 days free. That's the offer. That's the benefit. All right, so let's move on to the final thing that I want to go over today. And then I want to tell you a little bit about, let me actually, you don't mind if I just do it now, because we only got 10 minutes left. Before I go into the final section, I just want to hit a couple housekeeping things. So folks, many of you know this, but a lot of you don't, especially if you're here for the first time. We do 6 live webinars every single week. Every week we do these webinars. You're on one of them, but we did one this morning at 9:30 called WTF. The only way into WTF is either be on my Facebook, okay, and be a friend of one of the Facebook groups, or the best way is YouTube. You go into YouTube, you subscribe to my channel, and you click the little bell, and it'll notify you when we go live. When we go live at 9:30 for MSTV every Wednesday morning. This you already know about. We do Ask Me Anything Happy Hour, which again is through YouTube or Facebook. And that would be where you can ask any question. We do Take Back Control Tuesdays, which is 1 p.m. Eastern every Tuesday. We do Money Club Monday for Private Money Club. That's every Monday at 1 o'clock. Notice how our theme is always 1 o'clock. And then every Thursday, we also do Quick Start, which is at 1 o'clock. So we do all these webinars every single week, and we are consistent as hell. See, I believe that faith, if you have faith in what you're doing, that forces you to be consistent. And I have faith. We have faith. All of my team has faith in what we're doing. That's why we're so consistent and persistent, because without faith, you would never be consistent. If you don't believe you can succeed at something, consistency will falter. So we are incredibly consistent. You can always watch the 90-minute video. So you go into my YouTube channel, or you go to chrisnaugle.com, or you go beyourownbanker.com. Any of those, there's going to be a video that pops up. It's a 90-minute training on what you heard me talking about today, which is the infinite banking concept. You can watch that video. It's super fun to watch. And in that video, will allow you to book a call. Some of you might be like, hey, I want to book a call now. How do I talk to somebody about my situation? Great. We'll put the link up there. You can book a call with one of our mentors. We'll go through your situation, see what problem we can solve. And if we can't solve your problem, you're not going to do business with us. So we only work with people that we can solve a problem. We're not trying to sell you anything. We're trying to solve a problem, and then you'll ask us to help you. So you can do that. We also, this year, coming up in 2025, we got a lot of changes. I'm not going to be on the road traveling to other people's events, hardly at all. The only events I will probably speak at will be boardroom mastermind events because I'm part of that group and I love that group. Outside of that, you're probably not going to be able to see me speaking anywhere. So the only way you're going to find me is through our live virtual trainings or our private money club money tank events. Or some of you can join us for the experience, which is going to be the last experience. This is kind of a sad moment for us. Stephen, I want you to talk a little bit about experience in a second. This is a really sad moment because let me ask a question. How many of you have been with us for a year? Put 1 year. How about 2? How about 3? How about 4 or 5 years? How many years have you been around this campfire? Put it in the chat right now. And then how many of you are going to be with us 6, 7, 8, 9 years? And it's awesome. Look at how long. Look at Felix said 20 years. I know FCAT's not going anywhere. Well, there's something that's not going to be around in the future. And it's called the experience. It's an event we did, the Money Multiplier Experience. We've been doing this event for years. Many of you have been to this event. It is an event like none other. And trust me, I know that because I go to a lot of other people's events. The experience is special because it's not an event that you come to where we're in a conference room sitting around just talking at you or having speakers talk at you. It's an event where what we do is we meet, and every single day you pick an activity, you pick an experience, and you go off with a group of people that have like-minded or that are like-minded and that pick the same experience. And then you guys experience things together with high-level people. Maybe some of you will be in the group I am. Like I'll tell you right now, the day that we get to go up on the hill, snowboarding and skiing, that's where I'm going to be. And then one of the days I'll probably be zip lining. And then the one day we're going to do a group activity, and that's going to be hot springs. Sundance just put in hot springs. It's epic. You don't have to go in the hot spring if you don't want, but we're going to be hanging out there. We're probably going to have beer, maybe some cigars. It's going to be a good thing. And then we're going to finish that hot springs up in the Owl, which is an epic thing. I'm not going to tell you what it is, but the Owl is renowned. It is famous, and we are making it more famous. So this event will be the last one. So it won't be any more that we can say, hey, if you can't join us for the Sundance experience, hey, join us for the next one. There will be no next one. This will be the only one. So if any of you want to join us, there are only 10 tickets left. Only 10. So I'll have Stephen kind of show you a little bit. Can you pull the site up real quick, Stephen, and just show them about the experience? And then, folks, I promise I got one last thing after this that I want to go over with you. Take it away, Stephen.
All right. Yeah, I mean, so Sundance, Utah. I mean, what else can we say about it? It's probably one of the most beautiful places in the country, and we're going to spend. We get there Thursday, so here's the agenda. I'll just kind of give you guys a quick little preview of this. So arrive Friday. Arrive Friday to the resort, check in, get settled, and then we're going to do a welcome dinner and hang out Friday night. Saturday morning, we'll get together for breakfast, and then we'll do activities. So basically, Saturday and Sunday, you're going to be able to pick what activity you want to do each day, whether that's skiing or snowboarding, or what is the thing where you put the big shoes on and walk around the snow, like hike around? Shoes?
Snowshoeing.
Yeah, snowshoes. So they have a snowshoe excursion. They have, I believe, zip lining. You could do a spa day. They have different activities. So you can pick each day what you want to do. And we'll do that in groups, and then we'll get together for breakfast, lunch, and dinner each day. And then typically we end up at the Owl, which is one of the coolest little bars I've ever been to, overlooking the whole resort there on Sundance every day in the evening. So, you know, Sundance is not stage speaking. We're not like sitting in a ballroom listening to people talk at you from the front of the room. Nothing wrong with that. I mean, we do a lot of that too with Money Tank and other events, but this is the experience. So this is about spending time together, spending a time with Chris, spending a time with our executive team, some of our high-level partners that we bring in, different experts in different areas of investing and business, and just really being together and working one-on-one and develop those relationships for the future. So it's definitely my favorite event we do every year. And we're only doing this one in February in 2025. 2025 is too busy with other stuff going on. So unfortunately, instead of doing a couple of these, you know, one in the spring, one in the fall, something like that, we can only do the one in February. So be there or be square. You're going to miss out.
Awesome. Thanks, Stephen. Somebody just asked, why is this going to be the last one?
Just busy, man.
It's really kind of heartbreaking that I got to answer it this way, but it is what Stephen just said. We have so much going on. We're doubling down with MSTV. We've got the private money club, money tank events, which we've really had a great time with. And we feel that they provide a ton of value. And not that the experience does it, but it's different because the experience is experiential. And, you know, we just looked at the calendar. There's only so many days. and we all have families as well, and we don't want to be on the road nonstop. So we had to cut something. Something had to go. And unfortunately, because experience is only 25 people, we only allow 25 people to come in. I'll be perfectly honest with you. The experience is very, very low profit, if no profit. We did an experience out in Orlando. It actually cost us money to put that event on. We don't want to raise our price and have one of those events where we're charging $20,000 just for you to go and hang out with us for 2.5 days. I hate it. I just paid 20 grand to go to someone's house for what I thought was going to be an unbelievable experience, to be literally kind of rushed out of the person's house because it was like getting to closing time. The shuttle's waiting for us. And I'm like, wait, I had no proximity. I never even got to talk to you. We didn't even get to, I didn't get to really even ask the question. Everything was a big rush. And I just don't want to be that guy. I don't care how big I get. I don't care how big of a name I get. I don't care if people want to pay me 20 grand to be in front of me. I just want to provide massive value. And I want to do it at a price that everybody can afford. And therefore, we had to cut something. And that something happened to be the experience. So that's just what it is, right? You need 35 hours in the day to do everything we want to do. And, a 25-person event that is low profit that we love, it just had to be on the chopping board. That was it. All right, so that's that. We got 10 seats left. I'm sure we'll see a bunch of you there. I'm going to move on. This is like a bonus round because we're over time, but I thought this was really important. I've been hearing this thing a lot, and that is high-yielding savings accounts. And I know some of you have to jump because we're over time. If you got to go, no big deal. This is a bonus. So how many of you have a high yield savings account that pays you more than 4%? Anyone? Anyone have a high yield savings that pays more than 4%? All right. So Ethan said yes. So I've been hearing this a lot. A lot of people are like, wait a second, Chris, I've got a, I just was talking to a guy that exited his company at a mastermind I just spoke at. He's getting 4.4% in his Schwab high yield savings account. So Donna might be a little different. You're getting it from your parents. Kudos to you. But I just want to talk about that. So this 4%, a lot of folks think that this is going to stay. Like we're kind of caught in a weird period of time where the returns we're getting on money, safe money, guaranteed money, like high yield savings accounts, they're relatively high. And we get in this mode where we think this isn't going to change. But the Fed has been dropping interest rates. And if you've been paying attention to the high yield savings accounts out there, if you've been really watching, they've been dropping. We used to be able to get over 5% in savings accounts. Now we're down to 4 or under. And the reason for that is the banks have to support their high yield savings account returns with treasury yields. Treasury yields are going down. The Fed is dropping interest rates, which is going to affect all high yield savings accounts. They will go from 4 down to 3, 3 down to 2, 2 down to 1, and hopefully we never get to the point where we're getting nothing on savings accounts, because that was not too long ago where we got nothing on our savings accounts. You all remember that. It feels like it was yesterday. This is a brand new thing, but I want you to all understand that while this is good today, this is a short-lived thing. The Fed is going to drop rates supposedly one more time this year, and they will continue dropping rates into the new year. Mark my words. And as they do, your high yield savings will continue to hemorrhage and drop the interest rate because banks have the ability to do that. So the one thing I want to talk about, and the one thing Shauna put here, which I thought was a great topic, was the key concept is instead of doing a high yield savings, why would you not just move that to a specially designed whole life where you have a guaranteed interest rate that never changes? Right now, the guaranteed interest rate on most of the policies we write is 3% for the rest of your life, guaranteed in a contract. Plus the dividend. Right now, dividends have been going up. So these rates are going down, but why are those going down? Because the Fed's dropping rates. Why are dividends going up? Because yields on bonds are going up. And the insurance companies gobble up these long-term bonds. They lock the rates in. Therefore, they can pay these dividends into the future. So dividends are going up. We literally have one company that just went from 6% to 6.4. We have another company that went from 5.25 to 5.75. Why? Because dividends are going up. So you're guaranteed this, but the dividends right now are on a tear. These are the returns we're getting. And over here, when you make 4%, that 4% is taxed. I had this talk with this guy that exited his company, and he was getting like 4.4 in Schwab. And I said, 4.4, you have to pay tax on that. And he's like, yeah, unfortunately, I got to pay tax on it every year. So are you really making 4%? Or are you making more like 3 after taxes, or more like 2.5 after taxes? You see over here, this return, even if it's just guaranteed, is tax-free. The other thing about your high yield savings or your Schwab, it is not protected. So it is probatable, like I mentioned. So Most of these accounts are probatable. Not only that, they are not protected against judgments or liens. Over here, this is protected money. This is protected against judgments and liens in most states to a certain level or unlimited. It is also probate free, or bypasses probate is what we would call that. So all these are the reasons why I can't understand why people are so excited about their high yield savings. When we look at the specially designed whole life, you're going to get all the same things from a return standpoint, but it's going to be better, more stable, more consistent, and a lot more. Oh, and by the way, if any of you have a family or children, we've been hearing a lot of stories like the health, Brian Thompson, I believe was his name, from United Healthcare. There's a lot of crazy things. I mean, a death benefit sure does come in handy when the unforeseen happens. And I've been unfortunately, this year, a lot of people have passed away, and I've been on the front line for a lot of that. A lot of our clients calling in death benefits for loved ones. Like I said, my old project manager's mom just passed away. All those things, like, this becomes really important when that unforeseen event happens. And if all the things were the same, if what you were getting in the savings is what you're getting in the whole life, let's call it equal, and then you just got a death benefit on one, that would be all the more reason. And the only downside to the policies is the first couple of years, because the first couple of years, you're going to be at a negative draw. So that's all you're going to give up, is a couple of years to benefit for the rest of your life. And I just wanted to end with that, because that is such an important thing. Sometimes we just need to check ourselves. Sometimes we just need to look at ourselves in the mirror and just really come back to the logic behind our decisions. We are allowing right now emotions to make decisions for us. We are allowing our emotions to drive our reactions, to drive what we do with our money, and it is costing us. It will cost us our financial futures if we're not careful. I'm just trying to show you the path, folks, because I'll tell you, in a couple months, maybe 6 months, I don't know how long, there's going to be a lot of people that are looking at what we teach saying, boy, I wish I would have, I should have, I could have. But instead, I went into the risky assets. Instead, I kept going where my advisor told me to go. I kept putting money in the stock market. And boy, I wish I didn't listen. I wish I would have listened to you guys. Don't be that person. Steven, close this out.
It's like throwing in a closing pitcher without being warmed up first, man. Come on, you've been ranting for 90 minutes. I got nothing here. But no, it's been a good show. I mean, really. But no, seriously, guys. Thanks everyone for being here. We do also have 5 other webinars we do every single week, free of charge. So hop on those. It's all great education, new stuff every day, live shows. Just a quick reminder, though, since this does fall on a Wednesday and Christmas and New Year's are on Wednesday this week or this year, we will not be having our Wednesday shows on Christmas Day or New Year's Day. So a little break for Chris and the team and a little break for our audience. But make sure you're back here January 8th, because we will be going every single Wednesday for the rest of 2025 with Wealth Webinar, with What the F in the morning, and Ask Me Anything in the afternoon. Wednesdays is all about webinars, and it's always a really powerful day. So make sure you're joining us for all of those shows. And if you want a little bit more structured, educational, training style, do make sure you join MSTV, because we will be adding a lot of new training content specifically to MSTV in 2025. And of course, if you need us for anything else, just reach out. And I am looking forward to seeing a lot of you guys at the experience in Sundance. So get your travel planned now. I'm actually just booked my travel yesterday. So flying out and get there Friday morning. And then I think I'm going to leave Monday or Tuesday. So getting that all solidified now. So looking forward to seeing everyone out there. But yeah, Chris, thanks for throwing me in, man.
Yeah, I always like to throw you under the bus right at the end. Somebody in the chat, in the anonymous, asked about the difference between UL and whole life. I've got about 6 or 8 videos on that. I'm gonna give this video to you in the comments right there. This is just one of them, the facts, IUL versus whole life, and I've got a whole bunch of other ones. And if any of you want that same thing, you're like, oh, that'd be interesting, I've been wondering what's the difference, then just go here to my YouTube page, go to the search and just put in IUL or put in UL, and boom, there you go. Like the truth about IULs, whole life versus IUL, stability and legacy, all these IUL. Well, I actually probably have more videos. Yeah, I have way more videos. Look at that. They just keep going. Wow, Stephen, I made a lot of videos on IUL versus whole life. So that's where you would go to get the information on that. But with that being said, folks, I want to call this to an end. I know we're about 10 minutes over our time, but I wanted to make sure I wrap that last part up. So with that being said, I want to give a big thank you to Shauna for helping while I was traveling for almost a week with all the prep for today. These ideas were great. They allowed me to really articulate and go through and show you what this is. But also, as we come to the close of the year, I want to just let all of you know how grateful I am and this entire team is that you joined us today and spent the time, because your time is the most valuable resource you have. With that being said, thanks for joining us for Wealth Webinar. We will see you on another one, probably this afternoon. Till then, have a good day. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.